Right, morning everyone. Welcome back to our morning kappa at 8. So let's start off with the Hang Seng Index. You can see that the Hang Seng Index continue to move sideways below this 20 days moving average. So what we do see right now here is that the momentum will remain soft until the Hang Seng are able to break past the 20 or the 50 days moving average, or even it break the 26,500 point level. That's where the momentum will grow stronger. So at this juncture, as we mentioned previously, you look at the Hang Seng market, right? There's a lacking of a clear leader right now, with the tech stocks taking a sideways movement so far. Now, if the Hang Seng were to correct on the downwards, pull back towards 25,000, or even have a steeper corrections towards 24,300 point level, right? The more defensive counters, such as the banks or the insurance counters would see some defensive play, right? And but however, since the tech stocks right now are consolidating, right? We do think that the Hang Seng will be have a similar fashions that it will be sideways between 26,500 and the 25,000 point level. So meanwhile, we'll be paying attention to one of the tech leader, Xiaomi, whether the corrections will find a consolidations base somewhere between 38 and 32 Hong Kong dollar, right? Same goes. We're also paying attention to the other leader, such as the 3690, uh, 700, and the 9988 Alibaba, whether they can resume on the upside movement, that they can lift the Hang Seng Index higher. So as of the US market, it has a close yesterday night, but it will resume today, Friday evening. Then on, it only trades half day in the evening, Friday evening sessions. But you look at the uh, sentiment as of Wednesday night, right? We can see that the uh, funds still prefer uh, counters such as the AMD, right? And also one thing that we have mentioned yesterday is that whether when the US market resume, right, especially the Oracle, can they sustain on their upward movement? Now, as on the Wednesday sessions or during the latest corrections, you can see that Oracle is one of the stocks that the market is doubtful whether they can continue to sustain, especially when their CDS insurance costs have actually spiked up recently. However, some argue that the market corrections are too deep, right? So that's the reason why Oracle have a rebound on the Wednesday night. Uh, but since Thursday the session was closed, we shall see that this evening, Friday, whether the Oracle can climb above this resistance on the upside. Now, if it does, right, and then on it will leave sentiments on the other tech stocks. Currently, I think the sentiment are much stronger in these two counter, Google and Meta, over at the US market, right? And so as for Malaysia, we still keep a bullish bias on the FKRI. Now, today is the month-end closing, and also today there will be a MSCI rebalancing, right? There will be some counters take out from the MSCI index, and some may actually include in the index. Now, nevertheless, one important effect is that the volume will grow much higher during 3 to 5 p.m. And that's where you can expect a lot of volatilities on the big cap counters, right? The more important is that after this MSCI rebalancing, from next week onwards, on the 1st December trading sessions, right? How the market react after this rebalancing act, which going to affect market from Hong Kong to Malaysia, right? And based on historical pattern have shown, after the MSCI rebalancing, sentiment will be calmer. And in the past, we always see that the December month tends to be more bullish than what we see in October and November. In fact, December is the one of the most bullish months in the second half of the year. Now, at this juncture, we still keep a bullish bias on the FKRI. We have a stop loss at 1570 point level. Now, FCPO have made a very strong counter trend rebound yesterday. So at this level, at this juncture, right, 4,000 level has become an interim consolidation support. And from here, right, the FCPO may test 450 and followed by 4250. So on the upside, right, we can see that the 200 days moving average remains as the overhead resistance. So we'll keep our stop loss at 4250. As long as stay below 4250, we'll keep the bearish bias unchanged, right? And as for the Malaysian market, a few counters that I think are quite interesting, like Allianz Malaysia, right? Which they have a break past the resistance on a very strong momentum. Then on followed by the MPI, right? Testing the immediate resistance at 33 ringgit level. Thirdly, all right. Also looking at the tech store, whether tech store they have yet to release their quarter results, which is going to happen this evening. So let's see whether today tech store could extend their upside movement towards 34 or even 36, right? And as for yesterday, the SC have published a few names that include in the Sharia compliant list. There are about 48 counters, right? Then on, of course, these counters will have a positive price actions today, and some counters, about 36 of them, fell out from the Sharia list, become a non-compliance counters, especially counters such as Triren, Malayan Flamingo MFM, and the other counter would be the ENO. Now, in the past, once the counter drop out from the list, we do see likelihood there will be a negative price actions. If it does happen, right, do see the ENO, we have downside risk. You could find the next support somewhere at 71, or even have a deeper corrections toward 63 cents level. Okay. As for trading stock this morning, I'll be looking at firstly the MBank, which break past 5 ringgit and 90 cents. So after the breakout, MBank may test next resistance at 620 and followed by 6 ringgit and 50 cents. Downside support is at 5 ringgit and 60 cents. Now, secondly, we have Leong International will cross above the 63 cent and half. So if the momentum sustained, Leong will be testing 67 and followed by 70 cents. Downside support is marked at 61 cents. So I'll stop here and pass on to Nabil on the Hong Leong Bank result. Thank you.
Thanks, Joseph, and morning, everyone. So yeah, Hong Leong Bank announced its first quarter results for the financial year ending June 2026. Results were broadly in line with our consensus estimates. I think net profit for the first Q was about flat on both a year-on-year and Q-on-Q basis. But I think the important thing to note is that the home operations, i.e. Malaysia, Singapore, Vietnam, these did really well. Pre-associates PBT was up 8% year-on-year and up 5% Q-on-Q. Sorry, as the 8 basis points year-on-year NIM compression was offset by strong loans growth of about plus 9%. Non-interest income was also strong, with fees and treasury income generating robust year-on-year gains. Now, the key drag to the headline net profit number was really on associate contributions from Bank of Chengdu, which fell about 17% year-on-year on two fronts. The first being adverse currency translation effect, and number two, a natural dilution of its stake from about 20% last year to about 18% currently. So at the core, actually, Bank of Chengdu's local currency profit after tax was about 5% up year-on-year for the 9 months ending December. For the 9 months up to September. So back to Hong Leong's home operations, I think loan growth in the first quarter was very strong, about plus 9%. This was broad-based across all customer segments and geography. but I think management is expecting this number to moderate closer to guidance in the next few quarters. The loans to deposits ratio is currently at an optimum level, which we think means that any NIM margin support ahead will have to come from deposit repricing and also deposit mix changes. On asset quality, I think the domestic gross bad loans ratio saw a slight improvement to 0.50% from 0.53% in the previous Q. Overseas was really where Hong Leong saw some slight pressure, where there was one Singapore non-retail account that went impaired. But as this account was fully collateralized, no provision top-ups were required. In fact, the loan loss coverage remains very healthy at about 160%, if you include the security value of collateralized exposures, i.e. the recoverable amount of your bad debts. So post first Q results, all FY26 guidance items were maintained. These include ROE of 11.5% to 12%, loan growth of 6% to 7%, and cost to income ratio of 39%. As at the first quarter, Hong Leong is trailing on the ROE front, again, more externally driven than anything else. But it is outperforming on the cost to income ratio line, where it did 36% versus a target of 39%. And also, I think one thing to point out, if you've been keeping up with Hong Leong news updates, I think you may be aware that the group has stated its intention, or rather stated its openness towards disposing a partial stake in Bank of Chengdu. But I think even if this were to happen, management shared that it intends to stay on as a long-term strategic partner. And this really is to capitalize on China-ASEAN flows that management sees will pick up over the long term. But I think with that said, if a deal were to go through, then the freed up capital for Hong Leong Bank will partly be returned to shareholders, with the remainder preserved for organic and also inorganic growth in its home markets. So we had made very slight cuts to our earnings estimates, but the impact to our target price is immaterial. We maintain a buy call on Hong Leong Bank with a 25 ringgit 70 cents target price. This is really on Hong Leong's operational resilience, undemanding valuations, and also the potential news flow support. So yeah, that's all from me. I'll pass on the floor to the next speaker. Thanks.
Thanks, Nabil. Hi, good morning, everyone. This is a company update report on IHH. We are maintaining buy with an unchanged 9.14 cents target price. So this comes after IHH latest briefing, which paints a clearer picture of where structural momentum is coming from. Mainly foreign patients, a shift to daycare or ambulatory care service centers, facilities, as well as early signs of stabilization in Singapore despite payer noise. So in Malaysia, negotiations with payers have resulted in discounts of between 12 to 13% being offered. And there is also a structural shift towards daycare setting. Meanwhile, broader payer pressure discussions remains ongoing via a joint ministerial committee on healthcare costs, in which we understand there could be a national procurement framework that is being explored that could potentially reduce procurement expenses moving forward. In Singapore, similar structural shift is being observed while IHH has embarked on a fork cementation strategy with its Mount Elizabeth hospitals, both Orchard as well as Novena, positioned for the high-end segment, while Gleneagles as well as Parkway East pivots towards package offerings to align themselves with mass market insurer requirements. In terms of the structural shift mentioned, it's a structural shift towards daycare as well as ambulatory care centers. While hospitals remains a large contributor to overall revenues, the shift towards these two types of facilities will grow substantially over the period of time. For example, in Malaysia, the 9 months daycare revenue actually stood at 400 million, which is up 13% year on year. And despite daycare services being priced at roughly half of inpatient treatment prices, the beauty here is that you would have higher bed turnovers and better efficiencies on a daycare setting, coupled with lower running costs, as well as it frees up inpatient beds for more complex, higher margin surgical cases rather than the lower yielding medical admissions, which could also address capacity bottleneck issues while still being payer friendly. That said, in terms of expansion plans, IHH earlier target of adding 4,000 beds remains, but the 2028 timeline is no longer a fixed anchor. We understand, the expansion will still be prioritized on high occupancy hospitals within its portfolio, mainly from the Malaysia as well as India hospitals. But they are open to tweak their plans to possibly set up more ambulatory care centers, which could be more economical and also allows IHH to channel lower acuity procedures out of the main hospitals to focus more on complex cases. That said, earlier capex guidance of around 3 billion may be potentially revised downwards to closer to 2 billion. No changes here to our earnings as well as TP. Following this briefing, we still like IHH for its regional exposure. So maintain the buy, 9.14 ringgit target price. That's all from me. I will pass on to the next presenter. Thank you.
Okay, morning. We have a third quarter 9 months results for Axiata Group. Essentially, the numbers were broadly in line with our expectations, slightly ahead of consensus. Reported headline PATMI was a loss. That was actually because of a one-off charge in terms of the impairment over in Indonesia, the subsidiary by the name of LinkNet. This second quarter in a row where they've actually made an impairment. So total impairment to date, it's about 397 million. A couple of one-offs as well that have affected the numbers. There's also a gain from the early redemption of USD bonds, very close to 600 million in terms of ringgit, and also accelerated depreciation charges for XL Smart, which is in the midst of integrating the networks. So if you strip off the three key one-offs here, 510 million in terms of net PATMI, this is about 68% of forecast. We do expect the fourth quarter number to be seasonally stronger, so it should actually close the gap into the December quarter. Earnings dilution from the deconsolidation of the Indonesian mobile assets way back in mid-April, as well as the removal of edotco Myanmar that was divested in June, partially offset by sharply lower financing costs. As you know, they've been on this whole exercise of deleveraging the balance sheet, so they've made an early redemption of 149 USD bonds, 149 million to be exact, which basically reduced their whole core debt further by about 9% Q-on-Q. Year to date, they've managed to bring down their whole core borrowings by about 2.3 billion, so that's quite a feat actually. Liability management is something that we'll continue to explore. Obviously, I think the ringgit, the strength has basically helped, so they're actually doing this upfront. In terms of operational numbers, a lot of numbers to go through, but I'll just point out two key assets that have actually performed quite well year to date. That's Dialog, which is the mobile business in Sri Lanka, and Smart in Cambodia. Smart is basically the leading mobile operator in Cambodia. I think year to date numbers are still holding up pretty well, single digit growth there. Some of the other markets have been affected quite a bit due to macroeconomic issues. edotco, which is the tower company, obviously were also affected because of the strength of the ringgit. So broadly, I think the ringgit strength has basically affected some of the translated revenues and EBITDA across its frontier markets, but I think Dialog and Smart continues to do well on a local currency basis. 9 months numbers in terms of revenue and EBITDA, this is for continuing operations, fell 8.3% and 7%. Like I said, this is basically due to the stronger ringgit. On a constant currency basis, that number, both revenue and EBITDA, actually grew 0.4% and 3.2% year on year. Group EBIT improved 12% Q-on-Q. That's also because of lower impairment charge this quarter versus that of the previous quarter, where they actually booked more than 300 million in terms of LinkNet's impairment. Just very quickly, in terms of other notable takeaways from the results call yesterday, I think they've said that the merger between XL and Smartfren is progressing well. The guidance from Excel's team is that they hope to have achieved about 500 million in terms of synergies over the next couple of years. I think for this year specifically, they are looking at 150 to 200 million USD in terms of net synergies coming from integration. So a lot of this will be coming from the decommissioning of the duplicate sites, IT, the infrastructure in itself, as well as marketing down the road. Celcom DG has done okay. Nothing to really shout about. I mean, you've seen the results, and it's really backloaded in terms of the synergies. They did say that this will be completed in FY26. So expecting greater synergies there. That's coming up. LinkNet, obviously, it's been a bit of a pain point for the group. This is basically a fiber core company. They've carved out the retail business and has since merged that retail business with XL. So LinkNet is basically standing alone as a fiber core company. Basically tasked to roll out fiber across the nation. There's been some issues in terms of rolling out, due to challenges. So they've actually made that the second impairment this quarter. So as a whole, I mean, if you look at Axiata, it's really a case of de-risking the balance sheet. They continue to do this fairly well. It's actually helped by the fact that the ringgit is actually stronger, so the exposure to USD is much lower versus that of previously. HoldCo debt is now 7.2 billion as of the second quarter. First half was 7.9 billion. It has actually come off quite significantly over the last 2 years. I think they managed to actually pare down the debt by just over 4 billion. So it's the process of de-risking continues. Obviously, the big the elephant in the room really is the monetization of assets, particularly that of edotco. I think the process is ongoing. Should be able to wrap up within the next 3 to 6 months. It's an extensive deal involving multiple jurisdictions. As you know, edotco is actually one of the biggest towerco in this part of the world, so they do need to secure approvals across the many markets where they have presence in. So if they do get rid of this particular asset, it's going to be a big coup for them to basically use the proceeds to reduce their borrowings further. So the net debt to EBITDA target by management is 1.5 times by end of 2026. That number as of third quarter is 2.6. It has actually come off over the last couple of quarters. So our downside risks to the stock is intensify competition across the footprint, lower than expected integration synergies, particularly that of Indonesia, and monetization of the assets, which is the edotco deal that's coming up. So we've made no changes to our forecast at this moment. Target price stays at 295 based on sum of parts, so still retaining our buy call. Okay, I think that's all from me. We'll see you again on Monday.